Hey guys, hope you're doing great in the lockdown. To kind of continue from the prior videos, I wanted to just show you guys some of the dividend stocks that I'm looking at right now. And one of my favorite ones on the market that you've probably never heard of is OTC Markets Group. It actually trades over the counter. The ticker symbol is OTCM. Now you might know of the larger stock exchanges like the New York Stock Exchange or the NASDAQ, but there's also a smaller exchange for smaller companies. It's called, of course, OTC Markets Group, and it's traded over the counter, meaning it's not traded on one of the major exchanges. Now, I've always been a big fan of stock exchanges because you get good exposure to the market, relatively stable businesses, and they're usually one of only a few companies in the business. So it's either a duopoly or a monopoly in some cases, and that's one of the reasons why I like OTC Markets Group. But I'll get into that in a little bit. Just wanted to talk about the numbers on a high level. So it's a much smaller company. Market cap is 350 million, trading at a 23.7 PE ratio, and the dividend yield is pretty good, almost 2%. It's actually one of the reasons why I like this company. They've been paying dividends for a while and increasing them as well. 1 year chart, or the year to date chart actually, they're down from about $34 a share. In the market route in March, it dropped to about $23, and it's recovered a bit since then. 1 year chart looks like this, relatively flattish. 5 year chart looks like this, a little bit better. So, back to my original train of thought. The reason why I like OTC Markets Group is because it's basically a monopoly on OTC over-the-counter trading of stocks. So if you're a smaller company that doesn't fit the listing standards of the NYSE or the NASDAQ, then you have to come here in order for your stock to be publicly traded. Meaning for small companies, they have a virtual monopoly. Now, of course, a lot of smaller companies aren't as financially sound, but there are a ton of them, so they turn over a lot. And the business has historically been relatively stable in terms of revenue growth and earnings growth. So aside from the dividend, which is yielding about 2% now, there's a lot of reasons why I like the stock. One is the monopoly status, as I mentioned before. But the second thing is it's a really efficiently well-run business, incredibly high margins, and they've had decent revenue and earnings growth over the past 5-10 years. Earnings in 2015 were about 88 cents, and 2019 they were about $1.25. And obviously, I do expect them to get hit a little bit due to coronavirus. Now, something that's really interesting about this stock is that the share count has remained relatively flat over the past 5-10 years. 11.3 million in 2015 to 11.7 million in 2019. And I'm a big fan of companies who are able to keep their share count relatively stable or actually decrease them with buybacks. And the reason for that is because a lot of companies have decent earnings growth, but the the growth in the share base increases at a high level too, then it kind of offsets each other. But in this case, any earnings growth will disproportionately increase the earnings per share. So let's take a closer look at the balance sheet. Since obviously the coronavirus, a lot of businesses have been in liquidity crises, whatever the term is. So they have a very pristine balance sheet. They have $28 million of cash, and they basically have almost no liabilities. They have some deferred revenue here, some operating lease liabilities, But for the most part, they basically have no interest-bearing debt, which is very nice in this environment when a lot of companies are going through a liquidity crisis. And it's a very, very high margin business. They generated about 17.9 million of operating income to about 62.8 million of gross revenue. So that's about a 28.5% operating margin, which is very high, and it's pretty standard for businesses like this to have such high margins, which is nice. They've also generated a ton of cash flow, at least 20 million in operating cash flow over the past few years, and they actually don't have a lot of capex. Most years they're spending around 1 million or less on capex, so it's a very capital light business model. And the final reason why I like the stock is the ownership. So the CEO is Cromwell Coulson. He's been at the company since, I believe, 1999, so about 20 years or so. And and he owns excuse me, and he owns 3.5 million shares. So out of 11.6 million shares outstanding, he owns about 30% of the business. So his interests are obviously aligned with ours if you own the stock. Overall, really like the stock, especially since it took a pretty big hit, almost down to $24 a share in the March stock market route. It's a great business. It's yielding a pretty good dividend right now, and it has a basic monopoly on OTC trading in the stock market. So it's definitely been a holding in my portfolio for a while now, and I'm really happy with how it's performed so far. If you're interested in the stock, I would definitely recommend taking a closer look at it.